Then please work through the lecture example and make sure you can reconcile budgeted amounts to actual amounts. Then if you are required to discuss variances, you can apply the following framework. First, you need to explain how the variance arose. So this is the logic behind why the variance is either favorable or unfavorable. So you can see I have included an example over here. An unfavorable material price variance obviously arises as a result of the actual price being more than the standard price. So that is how the variance arose. Let's look at another example. If you have a favorable material usage variance, that means the actual quantity used was less than what they should have used. That will result in a favorable usage variance. So that is how the variance arose. Then after explaining how the variance arose, you need to discuss why the variance arose. So in other words, you need to give potential reasons for the variance. Now the reasons can either come from the information provided in the question or it's your general knowledge. So first, look at the information provided in the question, see if you can pull the reasons out from the information provided in the question. If there are no reasons provided in the question, then you are forced to use your general knowledge. So once again, I've included an example over here. If you have an unfavorable material price variance, so how did the variance arise? Because the actual price paid is more than the standard price. Why did the variance arise? Here's a few potential reasons. Either the standards have not kept up to date with changes in actual material costs, so the standards might be outdated, and that's why the actual cost is higher than the standard cost. Or maybe better quality, more expensive material was purchased, or maybe there was a change in suppliers. So those are all potential reasons why you could have an unfavorable material price variance. Then when discussing the variances, you should always consider the interdependence between variances, or in other words, how one variance can be explained by another. So once again, I'm still working with the unfavorable material price variance in my example. If we have an unfavorable material price variance, and let's also assume we have a favorable material usage variance. This could be as a result of better quality material being purchased. So obviously if it's better quality material, it's going to be more expensive, and that will result in an unfavorable price variance. But because it's better quality, it might result in less wastage. And if there's less wastage, that will result in a favorable material usage variance. Now you can link this even further to the labor efficiency variance. If better quality material is purchased and that material is easier for laborers to work with, then that will result in a favorable labor efficiency variance. So please look at all of the calculations that you've performed, or look at all of the variances that you've been provided with, and consider whether one variance can be explained by another variance. All right, another example over here when it comes to the interdependence between variances is you can look at your sales variances. Let's say, for example, we have an unfavorable sales price variance because the actual price is less than the standard price, so the company actually sold their product for a lower price. However, as a result of that, you might then have a favorable volume variance, because by dropping the selling price, that might have created additional demand for the product, causing your actual quantity to be higher than the standard quantity, and you then have a favorable sales volume variance. All right, so just make sure you always consider that. Then lastly, please note, if you are required to comment on performance, you must clearly state whether the variance calculated indicates positive or negative performance. Obviously, favorable variances will indicate positive performance, and unfavorable variances will indicate negative performance. Then you'll remember, in terms of IAS 2, inventory may be valued at standard cost if the results approximate actual costs. So we can value inventory at standard cost as long as the standard costs approximate the actual. Now, it's important to note, if you've calculated variances, that means there's a difference between the actual results and the standard costs. because if the actual results were exactly the same as the standard costs, then you wouldn't have any variances. So if we have variances, then there's a difference. So it's important to note, if inventory is valued at standard cost and we have variances, that means the standard cost is not the same as the actual cost. So we need to decide whether those variances are going to be expensed as a period cost. So in other words, are you going to take the variances directly to profit and loss? And if it's a favorable variance, it will increase profit. If it's an unfavorable variance, it will decrease profit. Or, instead of taking it to profit and loss, are we going to adjust the standard? So in other words, are we going to revalue inventory? Because if we adjust the standard and inventory is valued at standard cost, that will result in inventory being revalued. So whenever we calculate variances, if inventory is valued at standard cost, we need to consider how we are going to treat those variances. Do we take them to profit and loss, or do we adjust the value of inventory? Now, in terms of IAS 2, abnormal wastage is excluded from the value of inventory. Remember, normal wastage or normal losses get taken into account in the value of inventory, but abnormal losses are not included in the value of inventory. Now, you'll remember from the example that we looked at with material variances, I showed you that standards take normal losses into account, and therefore variances represent abnormal losses. So all of the variances that we calculate represent abnormal losses. So in order to comply with IAS 2, abnormal losses should not be included in the value of inventory. So that means these variances should be expensed as a period cost. So in other words, you take the variance directly to profit and loss. And if it's a favorable variance, it will increase profit. If it's an unfavorable variance, it will decrease profit. However, there are two exceptions. So the rule that you can study is variances are always taken directly to profit and loss, unless one of these exceptions applies. If the variance arises as a result of an incorrect standard, so if the standard is wrong, obviously the standard should then be adjusted or updated, meaning that the variance won't be taken directly to profit and loss, but instead, by adjusting the standard, inventory will be revalued. Then another exception is if production is abnormally high, then the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above cost. And this is covered in the variable and absorption costing lecture. So if production is abnormally high and you've calculated variances, those variances will not be taken to profit and loss, but instead the value of inventory will be adjusted. But if neither of these exceptions apply, then the variance can be taken directly to profit and loss.